Opportunity or crisis? This is one of the most confused markets I've ever seen. Okay, well, I don't know if any of us saw this coming, but when I went to bed last night after recording and editing most of this video, the news about the potential debt ceiling agreement hadn't broken yet. This should be good news for the markets next week if our representatives can act like adults and pass this in short order. As you will hear me say later in this video, right now the equity markets are voting that there will be an agreement to raise the debt ceiling, and it's starting to look like the markets will be right. Watch the rest of this video to find out what the markets are telling us before we knew about this latest update. The markets appear to want to go higher, but some indicators are showing markets that are either scared or clueless. The equity markets are demonstrating an appetite for riskier equities, as you'll see when we get into the graphs and metrics. But is the Treasury market showing a flight to safety? Or is it just that long Treasuries are so beaten up, they present an opportunity too good to pass up? Let's talk about it. So as you can see, if we look back over the past 5 days, the past week, this is a pretty healthy looking market. You've got the NASDAQ 100 leading the way. ARK is coming in second place, and then the S&P in third place. Now the Dow and small caps here are both negative for the week, but the riskier stocks are up for the week. This is fairly good, although it's kind of treading water. And if we look back over the past month, very similar picture. ARK leading the way higher. The NASDAQ 100 coming in second place. It may have crossed here the last day. I don't know why this graph does this. And then SPY is coming in third place. Small caps fourth, and then the Dow's lagging. This is what you want to see, a healthy risk appetite. And then if we look at year to date, this has looked spectacular for quite a while. You have riskiest assets finishing first and second, NASDAQ and ARK, followed by the S&P, followed by small caps, and then followed by the Dow, which is actually down year to date. But that tells me that investors are putting their money in the riskier assets and leaving the Dow alone. This is very good. This is actually a very healthy look. And what if we look at the current bottom dynamics? Well, not much to see here, although it's kind of interesting because the risk confidence level is dropping as the bottom forming indicator is starting to head higher. This kind of gives you a nothing signal. What is concerning is that the safety confidence is shooting straight up here. Now, this can oftentimes mean that equities are going to be in trouble, but I don't necessarily think that is going to happen here. Maybe I'll be wrong. We'll have to wait and see. And why don't I think equities are going to be in trouble? Well, if we look at the risk versus opportunity metrics, you can see that this red line, the risk level, is well below 80. In fact, it's below 70, and it's pointing down. The risk acceleration, this yellow line, yes, it was kind of moving up higher here, but look at where it is. It's still not even at 45. This is a very low level of risk. Nothing to worry about here. And I also like the fact that the opportunity level, this bluish line, is heading higher as the market heads higher. So I don't see a whole lot to be concerned about right now. And what about equity versus safety? Well, this is telling an interesting story. You can see that the NASDAQ 100 has been in first place for the last 3 weeks. This is great. This is exactly what you want to see. What gives me some pause, though, if we look at cash was up here in the number 2 position. That was scaring me. And then it fell back last week to 4th place. So that was starting to improve. But now what do we have? It's moving back up again. This is giving me a little bit of concern. This is the one area that is giving me any concern, is how cash is faring relative to everything else. Now you can see that IWM, small caps, moved here. They were down here right near the bottom. Then they shot up here to second place. This was really great last week. It looked fabulous. And now they too have fallen off. So this is a little bit concerning. Now you can see that gold is right here dead last. The Treasuries are still in somewhat of an unhealthy relationship. You want the longer duration Treasuries like EDV and TLT to be above IEI and SHV and cash, and they're not. So we've got an unhealthy Treasury market still, and we've got an equity market that sort of looks healthy. And I like the fact that SPY has moved up. You can see that it moved up and now it's in second place. This is good. It's very confusing right now, and I think I know why. So let's take a look at the buying and selling pressure, because this gives a different view of the dynamics in the marketplace. You can kind of get a sense of the undercurrents, if you will. And if we take a look at the Dow Jones Industrial Average, you can see that the selling pressure, this orange line, has been above the buying pressure for the most part over the last several weeks. If we look at the S&P 500, you can see that the selling pressure has been kind of increasing for the most part, and now it's just kind of noodling and going sideways to nowhere. But the price action has been better on the S&P. You can see that it has gone up recently. What about the NASDAQ 100? If we take a look at the NASDAQ 100, we've got a very healthy rally going on here, and the buying pressure has been above the selling pressure, and they're kind of flipping back and forth here right at the end. So I think we're kind of treading water here till we get past this debt ceiling crisis. And then what about ARK Innovation? Again, a very nice rally here with a pullback, and you can see that the buying pressure has been above the selling pressure until this last Friday. So kind of a mixed picture here, nothing great. And what if we look at sector rankings? Well, what you're seeing here is the rankings for this week are on the bottom, and the rankings for last week are on the top. Now, these sector rankings tend to move fairly slowly because they're taking a longer view. But boy, I got to tell you, this looks very healthy. It looked very healthy last week with all the risk assets right up here at the top. You've got Bitcoin, technology, semiconductors, ARK Innovation, consumer discretionary up here, and cash way down here, consumer staples down here, utilities, a safe haven, healthcare, safe haven, all down at the bottom. Love this. This looks great. And then what about this week? Very similar picture, almost identical. You've got all technology up here, innovation, just like up here, consumer discretionary, same thing. Now gold has stayed put, don't quite understand that. But what I don't like is you can see how last week cash was down here, and now this week it's moved up, and consumer staples have moved up. So this is a little bit concerning, but not terrible. And what if we look at sector rank acceleration? Now remember, these move fairly quickly. So if we take a look at last week, we had ARK Innovation ranked number 1, semiconductors 2. We had 20-year long treasuries up here in the 3rd spot. Emerging companies, technology, emerging companies. I mean, this looks really healthy. Consumer discretionary, cash way down here, consumer staples at the bottom, and gold way down here. This looks fabulous. Now let's fast forward to this week at the bottom half of this table here. And I don't like this. We've got technology here. We've got semiconductors here, clean energy. That's great. Emerging companies. Consumer discretionary has moved up. That's great. But look at cash. Cash went from here to here. This is really a little bit concerning. Hopefully this will reverse and go the other way once we get past this debt ceiling crisis. And if we look at treasuries over the last week, you can see they really have struggled. The longest duration, highest risk treasuries, this purple line, EDV, and TLT, the orange line, finished positive and almost positive. And then the shorter duration treasuries were all negative for the week. And what about that yield curve? Yep, still inverted. In fact, it really gave me some pause. I mean, we were doing fairly well here. You can see how the yield curve was up here at minus 40 basis points. Now it's at minus 76 basis points. It's heading in the wrong direction. This is a little concerning. Now, Chairman Powell mentioned that we may not be done raising rates. Maybe that's what's causing this. I'm not sure, but this is not looking good right now. I'd really like to see this go the other way and become not inverted. So are treasuries a bargain? Well, let's take a look. If you look at last week, you can see the losses are very big. These are the maximum losses that have been incurred ever since probably 2007, 2008. And you can see that we're currently, this week, not far from those lows. I mean, this one, to get back to where it was, has to double in price. You know, this one's down 37%. So these are very near their worst case bottoms. And could they be a bargain? Maybe that's why we're seeing some action there. Investors are moving into longer term treasuries to some degree. These could turn out to be the bargain of the century. I mean, treasuries are lower risk, but you know, to get a double out of something, now it may not go back to where it was, but my God, you can get even 25% out of something as safe as treasury bonds. That's a home run. But I'm not saying that's going to happen. There's no prediction here. I'm just saying they're really trading at a big discount right now. And how does that show up in the buying and selling pressure? Well, you can see for SHY, which are short-term treasuries, you can see that the selling pressure is just through the roof. It's above 10, and the price has been just collapsing. Now, if we go a little bit longer in duration, the selling pressure is not quite as high. And if we go even longer in duration, over here, 7 to 10 year treasuries, the selling pressure is not only not as high, it's moving lower. And then if we go to 20-year duration, the selling pressure is the lowest here and heading lower. So this is telling me that shorter duration treasuries are not looking good right now, and longer duration treasuries are looking better. And that's in fact what you saw when we looked at the weekly pricing. The recent pricing in TLT and EDV were moving up very nicely, while the shorter duration treasuries were still underwater. And how's gold looking? Well, gold is looking not so good. It's not looking so shiny right now. You can see that we had a rally attempt here, then it fell back, it went up, and now it's really come down again. And you can see that the selling pressure has been well above the buying pressure over the last couple of weeks. Now, it looks like that's changing here, but we'll have to see how this looks next week. And what about Bitcoin? Well, Bitcoin has been really struggling. As you can see, we had a nice rally here, and then it's just been on a downward slope over the last several weeks. And you can see that in the selling pressure, which has been very high and has moderated a bit here, but it's still well above the buying pressure, which is the solid gray line. So this doesn't look really good right now. If we look over longer term time frames like year to date, the equity markets continue to look healthy, and in the shorter term, they appear to show good promise. Right now, the equity markets are voting that there will be an agreement to raise the debt ceiling. Treasuries are inching closer to their 20-year maximum losses. Does this mean they're ripe to buy right now? The question is, are investors starting to pile into long-duration treasuries because they're such a bargain, or because they're afraid of equity risk right now? I think investors are smelling a rare opportunity to make great returns in long treasury bonds because they've been so beaten up lately. Now, there's no guarantees that may not happen, but that's kind of my sense of what's happening here. To me, it looks like there's both a healthy equity risk appetite and a healthy treasury risk appetite. Hopefully, it'll turn into some serious gluttony soon. The debt ceiling is the big wild card over the next several days, and it's scaring some investors. But the markets are smelling opportunity to move higher. And in the meantime, we continue to stay long in our investment thesis, as we have over the past several months. I'm Calvin Rose, and thank you for watching Invest Smarter this week. That's all for now.